I think that silver, gun to my head, and I think it's reasonable estimate. We're not just going to see 200 silver. We're more likely to see something like 300 to 500 silver, and probably by summer. Now, during that time, maybe gold only goes up to 8,500, which is to say, does what it did twice before, another eightfold move. I'm really not arguing that's where it's going to stop, by the way. But even if it just did that, and silver said, hey, I'm going back to 3 to 6% of gold, wow, you're talking hundreds of dollars. Don't expect the normal. Yeah, bull markets come and go, they get overdone, they correct. And so this is a move by silver into a new reality. That's the best way I can phrase it. We've used that for about 6 months now. The old reality was a 50, half a century price range. And what we're arguing is this is not normal. Don't treat it as a normal. We shall see, but there's a lot of reasons for that. It lived in a relative performance status to gold, either side of about 25% of the price of gold. It dropped down to 17, 18% of the price of gold. Again, divide XAU into gold. And it would get up to 35%. So you could draw a line through this multi-decade range, and then we collapsed to 4% in 2015 when the bear market low occurred, and gold also in this spread. 4% in something that used to be, on average, 25% of the price of gold. The miners were like free, relatively speaking. When you go to, you're not going to go to zero. Okay. You've lived in an 11-year range between that 4% lows. There was a couple at 5 after that, and just over 8%. We're right now at a level with a few days left in the month where you're going to break that spread out of this 11-year base. So what the spread is telling us is if you're in the monetary metals, begin to shift to the miners. The prior set of lows on that chart, if you looked at it, you would say, well, we're going to go up and bump the floor, the multi-decade floor. Well, that's more than a doubling from current levels. Meaning, when you break out of this massive clear base, it's likely you're going to go to next resistance, but that next resistance requires that miners more than double their current relative value to gold just to bump. Don't be surprised that it lasts. I'm betting, I'm not betting, I'm analyzing, probably into summer, June or July. There will be a jiggle in the middle. And I don't mean what we saw today or these a jiggle that really, you can see it on a monthly chart, for example, not just a daily. I don't think we're there. I strongly suspect that jiggle won't even occur until we get into like later in this coming month or March, and probably at much higher levels than we saw today. But even that jiggle is not the top. It's
Okay.
just a midpoint.
Silver is breaking its 50-year range. Analyst Michael Oliver forecasts $300 to $500 by summer, as silver is still cheap versus gold. Mining stocks are breaking from an 11-year base and could double. A March pullback is a buy chance, not the top. The trigger will be a bond market panic and massive central bank printing, sending money into metals.
You could have bought and sold at the same price for a 3 month period, up, down, up, down. Okay. And in 2010 to 11, there was actually a reversal month. In January of 2010, the buy signal was in September of 2010, the spread breakout. It ran up to January high and reversed. You had a total collapsing month in silver. And you ended up closing that month out, January, the reversal month, something the price chart guys would go crazy about. That's the top, right? Okay. Turned around and went up even more by April than it had in the first part of the move. $4 to 50, $4 to, et cetera. Just caught in this range. And frankly, while gold in that same period of time would take out its prior high by many multiples. Well, silver was still contained in a little box. Like, we don't need silver anymore. Well, they find out they do. Okay. They needed an AI. They needed, all this stuff, solar panels, the whole thing. So there's a new reality there fundamentally in terms of the industrial demand versus the supply deficit. Ignore them. Silver is going to a new reality. It's going to do, and we've shown studies on this that have happened in other markets. They're rare events. When a market is confined in a price zone for too long, like multiple decades, not reflective of the ongoing collapse and decay in the real buying power of the dollar. So not reflecting the real death of the dollar, not the dollar versus other currencies, but just the dollar in terms of its real value. They break out. Copper did this in 2005, late 2005 through early, about mid 2006. It quadrupled in a couple quarters. It lived in a range from 50 cents to a buck 50 for like 30, 40 years. And when it broke out, in literally a couple quarters, it quadrupled in price. No specific event for copper caused that. And it wasn't common to all the base metals. It was just copper. Okay. Then lead did the exact same thing in 2007, where it had been in a range for like 30, 40 years. Finally said, oh, I'm out of here. And it quadrupled in a couple quarters. And then after that lived in a new reality, quadrupled the price basically of what had been the old reality. Well, silver, why was silver confined in a 50-year range? While gold wasn't, copper wasn't, lead wasn't. Well, there's some arguments as to why. Okay, I won't get into those. But once it gets out of that range, it's saying, I'm PO'd. I've been kept back. I'm not in reality. I'm going to a new reality that reflects the ongoing decay in the money unit. My relationship to gold has been too cheap too long, et cetera, et cetera. And it's having a tantrum. It's still money. People forget that. They don't consider it the same as gold. Well, humankind has, for 3,000 years. And right now it is very cheap. Ounce of silver, respect to an ounce of gold, it's like 2% right now. Early this year, silver was like 1% of the price of gold. So it's had a huge move. When you go from 1 to 2, that's a doubling. Okay. So it's definitely caught up, but it's old reality when you measure that ounce of silver versus the mama metal, the monetary metal. Back in the 79 to 80 bull market when silver, again, in that box, $50 peak, ran up to 50 bucks and it was 6.5% of the price of gold. In fact, it stayed up there a while too. For a couple of years, it was in that 6 zone. Okay. Then in the 2011 bull market, when we went from like 10, 15 bucks up to 50, took a couple of years, a lot of it in the last couple quarters of that move, just like in 79, 80. Silver reached a relative peak to gold of 3.1%. Okay. So even right now at 2.1%, we're still cheap. Expect that tantrum to be mostly occurred in a couple quarters. A couple quarters measured by what? We measure the spread relationship between silver and gold. That broke out of a massive basing pattern. And when that happened in 79 and happened in 2010, that's when you went berserk in both of those bull markets, where like silver like tripled, quadrupled in a matter of handful of months. We just broke out in November, and it went from up from like 1 to 2 to 1.5 to 3% in that 2010 to 11 move. We're only at 2.1%. So we're hardly overdone. The spread only just broke out 7 weeks ago. So if price broke out of its confinement range of a half century, consider the possibility that silver could reassert itself as the baby monetary metal and get maybe back up to the highs it saw in the last 50 years, which say 6+%, 3+%. Wow. I mean, and consider also the fact that it's not going to do that with gold going down and silver going up. They're both going to be going up. Silver's going to be going up more. So good grief. I mean, if silver were 3% of even current gold, you'd be like 150 bucks. But if gold goes on up, I've speculated on this before. It's just a truth. It's not a projection, actually. The 2 prior bull markets in gold were 8-fold dimension. From bear low to bull high, bear low to bull high. If you measured the dimension, the logarithmic scale, it was an 8-fold gain. Well, heck, if we do an 8-fold, gold's going to be $8,500. And if silver's 3% of that, ooh boy. Or what about if it's 6% of that? You get my point. Okay. This game is only beginning. So everybody thinks, oh my God, I gotta take the profits. And I understand, because if you've been in silver for even just the last 3, 4, 6 months or so, you're making so much money so quickly that you can't believe it. You broke out of that range several months ago. where gold said, I'm coming out of here. Okay. Silver at the same time did the same thing versus the S&P. The gold miners divided into the S&P did the same thing. So they all had this basing chart pattern, relative performance chart, and they all broke out in unison. Well, not just in terms of relative performance since then. Look at the net price gains you've seen since November: gold, silver, GDX, XAU index. This is a vertical. Okay. Smart money said, hey, the stock market's hanging in there, not really making much, it's fiddling around. I feel I don't like the risk possibilities there. I think I'm going to move some 10% of my portfolio over to gold and gold miners, maybe. If that, well, the head of the Fed of New York, Williams, in mid-November said the Fed is going to, quote, start buying bonds. They did. You could see it in their monthly reports. Been buying bonds. And we look at the action of bonds. At that time, they were like 117 plus T-bond futures, 30-year bond futures. They collapsed down to the 115 zone and it went dead between like 115 and 116 for like 8 weeks of total comatose. I've never seen such quiet, narrow price action in T-bonds. Go back years, I can't find one. Well, it means that one, they were under pressure because the rallies didn't hold, but two, something was holding them. Well, we know what was holding them. Okay. If you break through the bottom end of that range by much, and we've got some trigger numbers we tell our subscribers, and they're not far below lows we've seen over the last week or so. You get back down there, you're going to start to precipitously drop this market. In other words, sellers are going to dominate despite the Fed buying. That could create a mini panic of huge dimensions. In other words, the nightmare that they've been trying to avoid. They will print, print, print. In fact, I'm quoting the new Prime Minister of Japan, the woman who's reflective of Trump's views. She said, we're going to print, print, print. But right now, in March of last year, the close on the dollar index was 104.21. We said, it's over, it's going down. That was a major bear signal because we broke momentum, long-term momentum uptrends, not price. The price drop that followed took us from that 104 down into the 96, 97, 98, 99 zone, and we've lived there for like 9 months doing this. In other words, nice little rallies, but they don't go anywhere, and then right back down. And right now, we've traded below 97 again, like today, I think. You close the month out around 97 or lower, which is in the bottom sort of end of that recent range. There's an uptrend on the price chart. That's what everybody looks at, right? The price chart, the monthly bar chart of the dollar index. Going back to 2010, you can draw the uptrend line. You've been dancing on it for 9 months. So in other words, the reason it stopped going down is the price guys were buying this trend line, even though momentum's already broken the comparable trend line. Momentum usually wins, okay? If you close about 97 this month, and you've been there today, so, 3 more days, 3.5 days left in the month, assume that the price is now going to start to move down in a way that people notice. And so the dollar, you're right, is suddenly going to become a noisy thing and create some, side effects. And one of them, obviously, will help. It's just further fuel for gold.